Thank you very much. Hopefully this works. So my name is Matthew Lee, Managing Director at Lincoln International. Pleased to lead the panel. What we are going to look at today in the context of, as we know, the UK is going through CMA regulatory change. There are a few developments and headwinds in the veterinary market, and we thought it was a good opportunity to talk about the trends in the veterinary market, the ongoing interest of investors, and the pursuit of corporatisation, the benefits of that. So between myself and Stephanie and Daniel, we're going to be looking at the various markets and the sort of rationale for corporatisation and the different forms of corporatisation that the two businesses have. So yeah, I lead healthcare in the UK for Lincoln International and also co-lead for Europe, and animal health is one of the subsectors that I spend a lot of time in. Stephanie, do you want to introduce yourself?
So hello everyone, my name is Stephanie Surapilia and I'm the General Manager for Smartimus in France. I'm a chartered accountant. I have a sister who's a vet in Canada, practicing vet in equine. So this is a sector that means a lot for me personally. And the challenges that we're seeing in North America are the same challenges that we have here in Europe. And I think it's definitely a sector for the future.
Hi everyone, I'm Daniel. So I'm the founder and the CEO. I was CEO until January 2025 of Cevetis. And I will explain you a little bit later what we are doing.
Okay, thanks Daniel. So let's see if the flicker works. So it does, good. So just a quick snapshot. Lincoln International, we're an investment bank, global, 25 offices in 15 countries. We focus on M&A exclusively to private companies. In terms of the services we provide, in addition to M&A, we also provide capital advisory services, so debt advisory. We recently started private funds advisory, which is for the private equity community out there, looking at continuation vehicles and other forms of routes to returning capital to private equity investors through DPI. And we're also one of the largest valuation companies globally in terms of providing 6,000 valuations for private companies every quarter. And I think as part of the valuation team's work, they value 16 veterinary organizations every quarter. So as part of their work, they get quite a lot of insight published around certain markets. In terms of, rather than focusing on people, on the right-hand side, just an example of some of the transactions you see here. We've recently, in the last couple of weeks, just closed on Heritage Veterinary disposal in the US. We've just sold Summit Pharma to Swedencare. We've been involved with marquee deals such as IVC disposing some of the clinics in 2024 to Perwin and others under the CMA investigation. And there's a number of other transactions, Coveted disposal to or take private by TPG in the billions. Santé Vet, we did a continuation vehicle for Columna Capital, raising funds for growth on their business. So we're very active across the ecosystem, which allows us to give additional insights that perhaps others don't. Just quickly focusing on the M&A trends, which will give a backdrop to Stephanie and Daniel's section. In terms of the veterinary market, has historically grown very strongly across Europe, supported by repeat demand for a pet's life. Along the bottom, you see a number of the trends or the sort of support levers, be it growing pet population, humanization of pet care, which people are aware of. Insurance has played a large part in certain markets, certainly in the UK, where insurance is sort of 40+%. And across the market, generally, the trend historically has been one of strong single or double-digit growth. But as we look forward, we'll come on to some of the underlyings before I get there. Insurance penetration varies across the sectors. Obviously, Sweden, UK are sort of some of the top sectors, sort of countries that have insurance, and the pet insurance growth in the lower penetrated markets are now accelerating. So you're seeing that in France, Germany, Netherlands growing at north of 20% on insurance, which acts as a catalyst for additional services. Fragmentation we'll talk about, but again, the UK and Sweden are the most, but you know, France at 25% or 24% is catching up rapidly. And what we're showing there is that there are numerous markets that are still uncorporatized and going through that corporatization phase. Last year you saw Animalia in Italy and a few others. So, but the interesting dynamic that's changed is the COVID puppy kitten cohort moving into adulthood. This is data from the US, but as Stephanie said, there's parallels that are being seen in the European market. So as the puppies and kittens are now young adults, they need less vetting. They're coming into the veterinary clinic less, and therefore volumes are stepping down, and some of the corporates are having to deal with that. Obviously, price can still be put up, but at net growth is, for the moment, a lot lower. But encouragingly, as we look at public announcements by IDEX, Vimian, CVS, Trupanion, and others, it's very clear that the growth that is sort of slowed is a temporary issue, and everyone that is in the sector is very clear that this is going to be reversed, and the big debate is when is it going to be reversed. I think talking to people at VMX in January, the consensus was somewhere between 1 to 2 years. I think 1 is probably more hopeful, 2 is more realistic, but as Stephanie and Daniel will highlight, that some of the local different markets are seeing this effect differently on a different time. But you know, all of the data there, all the talk is one of positivity, and that's really continued to drive strong M&A and investor interest in the sector. So you've seen deals back in 22, Univet, Servetis, 23, Ardien with Montveto, Bivet in Belgium, and then last year there was a number of deals across Europe, in Ireland, in Italy, in Czech Republic, and a marquee deal with TPP Inflection. We're also aware if merger market is correct, and obviously we're not sort of talking anything confidential, it's what's in the press, if that's true, but Altano, Equine Care Group, and Vitopia are allegedly set up to transact at some point this year. So it will be another, if that's correct, it will be another sort of return to form for the sector. And if you look outside of the veterinary space, just clinics, ignoring clinics, just this list shows you how active the ecosystem is, but also, and therefore how much interest there is in the broader ecosystem, be it pharma or be it education platforms like Improve International, Bridgepoint with microchipping database services. So I think everyone is very clear that growth is a long-term. People like Mars, JAB, others, they're not in it for 5-10 years, they're in it for a generation. So the growth drivers are very long-term, and that's why there's a lot of investor interest across the ecosystem, and that's benefiting the corporates as well as wider opportunities. In terms of valuation, it's sort of asset specific, but I think on average, if you take across the OEMs and anything that's listed that touches animal health, I think valuation depends on where you are, but 13 times, but you've got Trupanion in there, you've got IDEX, you've got others, so it's not really a fair transaction. I think on the top, Lincoln value 15 or 16 vet corporates globally, and that's sort of coming out at 11, 12, but these are sort of quite conservative valuations, which are more driven by the sort of credit fund compliance type valuations rather than what's being achieved in the market. If we look at what was achieved last year, a number of deals were in the teens or mid-teens, upper teens, depending on what the transaction was. So we're still seeing, despite interest rates going up, we're still seeing some pretty interesting multiples being achieved. But certainly, when we're looking at the 20s and pluses from 2021, those are certainly not there. So I think that the valuation side is still pretty positive. And just to wrap up, a summary in terms of the long-term positives with some short-term challenges, and a pretty interesting look forward for the sector, and one where we think there's going to be more activity both in the UK but also across Europe over the years to come for investors and opportunities for operators. So with that, I will hand over to Daniel. There we go.
French. Ça marche? Ouais, okay. Hello everyone. So I'm going to speak a little bit of who we are, and more particularly what we are doing to drive the growth of that business. So it's quite a young business in France. The consolidation started probably 2017, 2018, and then accelerated a lot. As for Cevetis, we started approximately around that time. Today it's 225 clinics. We are present almost everywhere in France, except in 3 regions, the eastern part, where we never found someone who was able to make a deal over there. Normandy, because Normandy is a bit the home of Montveto, and the southeastern part of France, which is the home of my dear colleague Christophe over there. So this is the growth of the company. So as you can see, it was a busy last 6 years, and we started from zero almost, and we grew by acquisition, mainly buying between, at the beginning, 10 to 15 clinics per year. Then we had an amazing year in 21-22, where we bought approximately 80 to 90 clinics, and over the past 3 years, it's approximately 35 to 50 clinics per year. So the whole story of Cevetis is how do we transform ourselves from an industrialized acquirer to a real platform, driving like for like, driving growth, and I would say changing a bit the way we do the medicine in the company. So as you can see, and Matthew explained a little bit on the French market, but it's a 4 billion market, so I think it's probably something around the second or the third market in Europe. The CAGR over the past 7 years, so something between 5 and 10%, I don't know, 6.6, but so it's quite a good growth, honestly. We had some years in 2021 where the growth were much higher because everyone during COVID decided to adopt a pet. So a lot of puppy arrived on the market, and the puppy cost you twice for the first 2 years of his life than a grown or adult cat or an adult dog. So the growth has been a little bit different depending the years, but if you look at the long-term perspective, it's a very resilient market. Over the past probably 50 years, it's a market which grown by 3 to 4% every year, steadily, without any problem, and it will probably be the case in the future. Why? First of all, demographic expansion. People tend to adopt a lot more animal. The animals are much more medicalized now than 20 years ago, 30 years ago. And there is a higher demand for specialized care. In terms of price, it's a free market, which is rare in France. So for once, we can do a bit what we want with the prices. People tend to spend, of course, a little bit more per visit, and that's it. So you can see the consolidation rate. It's true statistics now because we've been monitoring it deal by deal. So every time we lose a deal to a competitor, we tend to put it in our database, and every time we win a deal, we put it in the database. So I can reasonably say that the consolidation rate is about 24–25% today. It went very fast over the past 3 to 4 years. As you can see, we went from almost 0 to 24. And what you can see over the past 18 months, between 23, there was a slowdown. And the slowdown, and we slowed down also, is mainly due to 2 things. First of all, the big international acquirers that were present in France, so namely IVC and Icura mainly, had to stop their M&A effort in France because probably they had other problems elsewhere in Europe. Now they are starting to come back again, and we did the same. For instance, in 2022, we ended up the year with 90 LOI signed, and when we begin to look at the current trading was not good. So we decided also to stop those LOIs, and we did only 30% of those LOIs, and we review completely the way we did M&A. So this is a transformation year in France when all the players went from, okay, we acquire everything we can, to, okay, now let's review a bit our strategy and let's see how we can focus a little bit more on like-for-like growth. I took a bit of time on that slide because I think it's quite interesting. So if I look a little bit at how do we do things at Cevetis, and maybe, when I was at HBI 4 to 5 years ago, everyone was speaking about M&A, growth, M&A. I think that time is a bit, I don't know if it's behind us because we are still buying 50 clinics per year, but we are really now trying to focus on, okay, how does this platform drive growth? And driving growth drives value. And we have tried to show that the sum of the clinics is, of course, more profitable, more efficient, and hopefully more valuable than the sum of the clinics. So at Cevetis, the idea is to work on those 6 pillars. Of course, service, acquisition and data marketing, and I will speak a little bit more about that after. Clinic quality and performance, M&A and integration mainly, procurement and the culture. What is super important for us now is to make sure that when we look at the US, when we look at the UK, clients tend to go twice more to the vet than France, and they spend twice more at each visit than in France. So potentially, we could make 4 times more money on each visit. So, and by that, we also improve the quality of the service that we are going to give to the dog or to the cat because they are much more medicalized. So for us, it's super important now to be able to drive our growth and to be able to drive our clients. So what we have been doing in the past 2 years now, it seems very obvious for other business than us, but we have to have the grip on our client now. So we have the client and the patient. The client is the owner, and the patient, of course, is the animal. So now we are really investing in the tools, and we are really trying to digitalize that company because we need to be able first to take the client where he is and to drive him to the clinic. Then we need to be able to make sure that we manage the life cycle of the client inside the production tool of the company, and then we need to make sure that he comes back. And what seems to be very normal for a company, having a very good website integrated, having the same PMS in all the clinic, having all the same systems in all the clinic, and having a CRM marketing tool, in the vet sector was not that obvious. So today, what we are able to do is we take the client somewhere on the internet because it's becoming to be our main acquisition tool. We follow him. We bring him to the clinic, or the clinic which is the most locally close to him, or the clinic where there is the good service for him. Then we need to make sure that he takes the meeting. If he doesn't take the meeting and doesn't visit us, we need to have sure that we send him back the invite to have it. So we follow him until the clinic, and then we make sure that he doesn't miss the next appointment and he doesn't miss the next moment in which he needs to come back to us for the health of his dog or for the health of his cat. So it's super important, and that is driving now our volumes much more than before. And for instance, when Matthew was commenting on the drop of volumes that we have been experiencing probably a little bit in the US and in the UK, what we are experiencing that we are flat in volumes at Cevetis at least, at the constant level of veterinarian workforce, and probably if we didn't have that, we would have experienced a little bit of a drop in volumes. To do that, we need to have a lot of KPIs. So I would never have been able to present that kind of slide 2 years ago, 3 years ago. So we are really maturing in terms of how do we work and how do we drive the profitability of that business. So the KPIs are, what is the owner and what is the patient experience, and that is super important for us to make sure that the medical excellence is always there. So satisfaction rate, number of appointments that you took in a year, average spending, number of new clients. Then we have the quality of life at work, and that in the end, we are a people business, and to manage a people business, you have to have a lot of indicators of how your workforce is working. And then the financial result, which seems to be a bit evident, but for instance, now we are able to manage the revenue per veterinarian, per slot in the clinic, per type of service in the clinic, and we are managed now to make sure that all the clinics are beginning to follow the best in class in the network. So this is really, 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 really important for us, and that is what is going to convert us from a serial acquirer to a platform that is driving growth. Sorry. Well, this is a quick illustration of what does it mean for us when we say, okay, we're going to drive the profitability of the clinic. So on the left, you have the average profitability in the historical account of a company that we're going to buy. Then in the middle, you have what we can reasonably expect once they integrate the group. We value the company not on the 23.7 because the 23.7 is already adjusted from our synergy, but we value the company around 19 to 20%, which means that we give back part of the synergies to the owner of the clinic when we valued him. And we achieve 26%, it's the clinic EBITDA. So we see that now we are able to improve the profitability of the clinics on the revenues, on the gross margin, and of course on the staff cost because this is the way we do it. So it's really about how do we prove that all the levers that we are activating in the company are in the end shown in the financial results. So it was a very quick example of how we do this, but maybe I can answer some question later, but the idea was really to show now that the French market is quite consolidated. Still, we continue to acquire, and Christophe here will probably comment the same. But we are all focused now, and we know that we need to integrate our clinic. We need to be very, very good and have an excellence at integration. And we cannot hope that the valuation of this business, which historically have been quite high, will maintain if we don't show that there is synergies and that there is value in the platformization of the companies.
Thanks, Daniel.
Pardon. Tiens. Je t'en prie.
Okay, so now we'll continue with Smartimus. So who is Smartimus? We're a collaborative network of independent veterinarians, and as you can see, we're even younger than Cevetis, so we've been around since 2021, so we're super newbies. But since then, we've grown to over 100 clinics in 2 countries. That's France and Germany. And so I'm going to take you through France and Germany, focusing a little bit more on Germany because Daniel's explained France quite well. The trends are very similar, though, and we're going I'm going to explain how Smartimus has chosen to corporatize the veterinary sector. So here we have Germany. What I wanted to show here was that the veterinary services in Germany is, just like in France, it's an extremely resilient sector. So over time, so here it goes from 1999 all the way to today. So there's a few areas where there were difficulties. This is the Lehman Brothers crisis, it's the usual crises that we all know about. But over time, veterinary sector is an area that grows. And interestingly, 40 million pets in Germany. And the reason I point this out is that if we look at France, which is the next slide, I fell off my chair when I presented this because 75 million pets, I thought, wow, bigger than Germany. But actually there's a lot of fish in France. So once they don't go to the vet. So there you go. I just wanted to make sure everyone was listening after lunch. So you can see it's the same trend. It's very, very similar trend to Germany. So France and Germany, we targeted these markets as being areas where there's enough money, just like North America, to spend on pets, and enough people so that spend matters. So what is the case for corporatization? So at Smartimus, we believe that we're stronger together. So there are pressures on veterinarians that mean that corporatization makes sense. The first one is that there's more people on Earth, more people living longer, more people buying pets, and the pets are also living longer. People are becoming more sophisticated in their own healthcare, but also for their animals. This creates a lot of stress on veterinarians because they have to provide better healthcare to people who are much more savvy. There's also a demographic problem, which everybody has in every sector. So if you imagine a big X, the pyramid of ages is a big X. There are a lot of boomers, so that's the top of the X. Many, many boomers who are practice owners, and they need people to sell to. Who do they want to sell to? They want to sell to my generation, which is Generation X. And we're at the intersection on the X. We're the smallest generation alive. So there's just not enough of us, even if we wanted to buy out the boomers. Corporatization enables these people to realize the financial value of their practice. Below the boomers and below the Gen X, we've got millennials. So there's a lot of those, so it's going to go back out again. These people could buy, but they don't have the money. Also, they see ownership differently than previous generations. So all of these are reasons that make corporatization make sense. However, there are challenges, and they're people-related. How do you make sure that veterinarians who are entrepreneurs stay motivated? Because if they're not motivated, they're not going to deliver the sales revenue that you need, because these people are your sales force. How do you make sure that you keep talent? There is a shortage worldwide of veterinarians, so how do you make sure that your platform gets the people? Because without vets, again, there's no revenue. So corporatization answers some very real problems, but you got to do it in the right way. So at Smartimus, we decided to combine the benefits of local entrepreneurship with the power of a network, which is what is coming next. So we have a governance model that is structured around majority veterinary ownership and the associated earnings potential. So they are not employees, they are not freelancers, they continue as they were before to be partners, and they can absolutely make the same remuneration that they were making before. It's actually Smartimus who's on a fixed income. And what this does is it motivates veterinarians to continue being interested in their business and to want to work. Also, all of the medical decisions are solely in the hands of practicing veterinarians. So this keeps them engaged because, you know, these are health professionals and they came here to heal animals. It is important also from a regulatory perspective that medical decisions be clearly in the hands of veterinarians. So at Smartimus, we encourage and accompany the clinics to achieve growth through influence, and it's what we call a win-win scenario. However, we do also offer the power of a network. It is a community of like-minded entrepreneurial veterinarians. So I don't know if you remember from the early slide, I mentioned that we were a collaborative network. The idea is that veterinarians will share best practices between themselves. It's a lot easier to get change, to enact change peer-to-peer than top-down. Smartimus provides services that individual clinics need and would not be able to access on their own. So financial and legal acumen. For example, I'm a chartered accountant. They get access to people like me, and I will help them to explain what their accountant is doing. I help them to understand their numbers. I help them to grow as business leaders. We also provide human resources and recruitment. digital and IT optimization, as well as sales and marketing strategies. And so we absolutely believe that influence and engagement, collaboration, can be a really strong driver of growth. I wanted to talk a little bit also about Smartimus and platform integrity. So we believe Smartimus, although it's a customized approach to platform integrity, although it's a system that gives a lot of power to the veterinarians, it's actually low risk for the owner. There's a lot of operational stability because we're operationally light. We run on a toolbox mindset, so Smartimus is very, very light. We don't have a big corporate head office. We rely on peer-to-peer education and on providing toolboxes veterinarians can access, and at their own rhythm, they can make the changes that are needed. Financially, vets retain most responsibility, and Smartimus gets a steady, low-risk cash flow. In terms of scalability, all our documents, all the legal work is standardized, so it's very easy to roll out from country to country, and actually from profession to profession, because whether it's veterinarians or accountants, is actually, we are now experts at handling regulated professions. In terms of leadership, we have practicing vets who are on the board of directors, so this is how we make sure that everything stays true to the profession. And I think the strongest part of Smartimus is our governance. So we have very, very clear governance between Smartimus and the veterinarians. It's clearly delineated, it's fair, and it's completely compliant with French regulation, which I think is one of the strictest in Europe and probably in the world. So just to finish, we must be doing something right because we are on track to exceed 200 million euros of revenue by 2027. We've had spectacular growth in both countries. And so we will be, I'm sure of it, the leading enduring network of independent veterinarians in Europe. Thank you for listening.
So I think, let's just move that to there. I think we've got 12, 13 minutes for questions. So if people want to think about questions while I ask a couple of my own, then we can come back to any that are on the floor. So maybe I can sort of start with sort of topic of the moment in these conferences, AI. I'd just be interested in terms of, for you, Stephanie, and also Daniel, how are your businesses, if at all, using AI, or is it sort of yet to sort of properly land in France veterinary? Just some comments on that would be helpful, because I've sort of seen at VMX various technologies being sort of pushed. Just be interested.
Yeah, so at Smartimus, we've started getting interested in AI, and it's come up from the veterinarians themselves. So a lot of the veterinarians in our network have tested equipment that is supposedly AI friendly, and they say it doesn't work so well. So ChatGPT ends up being the most used piece of artificial intelligence, but we're at the beginning of a journey where we're trying to roll out much more artificial intelligence. We're really trying to help the veterinarians understand that it's something that can help them be more productive, especially in a situation of talent shortage, and to embrace AI rather than be scared of it.
Yep. Daniel?
You know, they try to put AI in the mouth of every CEO currently. So you know, every consultant tells you that as the CEO, you must own AI in your own business, and you do not delegate it and have it directly reported to you. Well, personally, first of all, we see where we come from. I don't know the other group, but we have an integrated data only since maybe 18 months, 24 months. We are digitalized. We have been digitalized only in the past 2 to 3 years. So personally, I think that AI will probably come in the vet sector, but not now. First of all, we make sure that we have an integrated platform, integrated database, integrated CRM, and then we will begin to deploy AI. AI can work for the vets in imagery, okay, as for the humans, it works. We've tested it. For now, it's not amazing. It can work a lot to help the veterinarians, you know, go faster when they speak, when they take notes and everything. But the main thing, and I don't know when it will arrive, but what you have to understand is that for pets, we can do almost everything that we want with the data. There is no RGPD or a bit of RGPD, but it's not like for the human. So what we see in the US is that they begin to have 20, 25 years of data on the pets, and now they are beginning to work on predictive medicine. And I personally think that this is going to be the future for us, because we're going to have so many data on the different type of dogs, the different type of cats, the different type of owners, the different type of regions, that we will probably be able at some point to have predictive medicine and to make sure that we integrate that in the way that we treat the patients. So in my view, this is really where AI can help us to make sure that we know exactly where we are going with the different animals and prognosis and everything.
Thank you. And just sort of focusing on the corporate model in your mind, and I think you've both touched on it in different parts, but what do you think the biggest challenges for the corporates are in your markets in terms of continuing to grow, get the sort of required resources on? What are the biggest challenges, independents versus corporates, for the corporate as you continue to grow and acquire? Perhaps you, Stephanie.
I think the biggest challenges are human. So these are professionals, they are liberals, they are people who are used to serving the public interest and being very independent. So the biggest challenge, certainly for Smartimus, is getting them to understand a more collaborative mindset and a more corporate mindset, because they're used to being alone in their clinics, being the most intelligent person, dishing out information to patients.
Has the acceptance of corporatization in France sort of accelerated with that M&A piece, or is it sort of resistance to it accelerated? Yeah, answering the initial question.
6 years ago, when I was saying EBITDA in a clinic, the guy would show me the door directly. I mean, we were seen as, the financial devil. Now they know the term EBITDA better than us. So yes, it's been accepted. I'm completely, I agree with you. For us, the most difficult thing is when you buy so many things so quickly everywhere on the territory, is how do you transform it from the sum of people with their own culture, their own processes, their own way to do things, into some culture, shared culture. This is the most difficult for us, because if the culture is not shared, if we don't have some values in common, it's very difficult then to have your network following what you want to do. And it's super important then, if you have a vision, some ideas, and you want to drive growth, you have to have a grip on your business. And if you don't have the right culture and the right values, and if they don't share it, it's super difficult. This has been honestly, the most difficult challenge, and it's going to stay the same probably in the next 5 to 10 years.
If we stay on the corporate model, obviously people will be following what's going on in the UK with the CMA and regulatory involvement, and obviously some of that pause that you talked about earlier was related to your own market's regulator getting involved with the ownership structures. As France accelerates, and also Germany, but Germany's further behind, but as France accelerates 24, 30, 40%, how do you see the role of the regulator? Do you see it as a risk, or is the regulatory involvement meddling over in France? Just to pick that up.
Yeah, so as you know, the first year of the consolidation, we had quite a few players, probably international players, that were trying to move the lines of what level of control you can have on the business, and it's quite regulated in France. I don't know if anyone knows it, but you have 3 main rules, and then you have all the lawyers in the world that can explain you this after, just on the next door. But the vets must be majority shareholder. The president of the main structure must be a vet, and you must maintain the independence of the vets. So there were quite some differences of view on that interpretation. And what happens in France, and now, we are working in a very pacified and very clear environment. So in 2023, the Conseil d'État ruled in favor of the Ordre des Vétérinaires in their dispute with some groups. And what the ministry did, and I think it was a very good move, they decided to organize a conciliation. And so we went, everyone in one room, So all the groups, l'ordre des vétérinaires, so the, the governing body, and the minister. And we ended up with a paper, I think it's a 10-page paper, or 5 to 6-page paper, which clearly defines now the setup in which we can operate. And in my point of view, it's very, very important to have a very clear setup. And now in France, it's super interesting because we have a clear setup. So we know exactly what we can do and what we can't do. And I think that gives a lot of peace of mind for the investors, a lot of peace of mind for me, honestly, as an operator. And I think the relations are really pacified. And hopefully, we have a very interested eye on what's going on in the UK now, because we see the CMA investigation impact on the organization of the networks, on the valuation. We see CVS, which traded at 18 times and now is trading at 7 times. So we have a very interested eye, but I personally hope that if we get to that in France, and it's going to take time, we have now the example of how we dealt with the situation in the order. And I think that we have a very, we have a good discussion between the minister, the order, and the group.
Anything to add there for Germany or?
Yeah, so Germany, interestingly, prices are regulated. So it's true, France usually is the country of Uber regulation, but in this case, it's Germany. Having said that, in Germany, there's a lot of growth, despite the fact that prices are regulated. But all professional prices in Germany are regulated. Accountants, lawyers, I think it's just a different way of operating. What happened with the prices in the UK, I think, is affecting France. I know that the order is extremely wary of that mess being exported to continental Europe. We have the doctrine. They've just released some guidelines around conflict of interest, so I don't think regulatory interest will disappear. But as I say, Smartimus worked it into our basic governance structure, so we've never really had any issues there.
Mindful we've got a couple of minutes left. I don't know if there are any questions on the floor. Charles. There we go.
Charles Cosgrave from Village Vets. Thanks very much, a really interesting panel discussion. I was just curious to understand the sort of the penetration or the usage, client uptake usage of your digital app or client interface, Daniel. And then second question on top of that would be how much of the average transaction value increase is driven by digital usage of that platform by clients?
Okay, you're gonna laugh. I didn't understand the first question. I'm sorry.
What's the uptake of your digital platform, your app that you had on your slides in terms of to drive the digital pathway of taking clients in?
What is the optic of that? What was the question? So what is the optic of that?
The penetration.
Oui, okay, sorry, Olaf. Alors, first of all, we don't have an app. Because apparently it's not fashionable anymore. So it's our point of view. So people want to be able to connect directly, on the website, directly from the phone. So it's not an app-led business, but then apparently that changes every 2 years. So, app become fashionable, then they're not. So probably in the next 18 months, we will do an app. I don't know. Second of all, we launched it 5 months ago. So now we are, the main, the main challenge is to deploy it in the network and to make sure that we have the acceptance of our vets, because change is not easy in a network. So we are still in that phase where, we make sure that the vets use it and accept it and that it drives value. But what we can see in terms of what we monitor is the increase of the share of the rendezvous, of the visit that are done online versus, calling or everything. So the share is starting to come from, before it was between 6 to 10% on the whole network. And now we are already at 23% of the rendezvous that are done online. So it's a real increase. And for us, it's super important. And second of all, it's the share of visits that are not cancelled, because we have a big problem is that people, they put some visit and then they don't come. So with the digital, with our digital tool, now we can make sure that the share of comment on appelle ça, non-honorized visit is dropping, and I think it's dropping from it was about 10%, and now we are at about 7%. So it's still too much, but we are dropping that. I don't have now the data, you know, on the increase in the average spent in the clinic.
Thank you.
Yep, here, up front.
Thank you, Vladimir, UMG Investments, a private equity fund. I have a question regarding valuation, a bit technical one, but when we looked at few targets, we actually faced two kind of valuations. So somebody is valuing on EBITDA of clinics level, and somebody is valuing on EBITDA of platform level, yeah. So apparently, if you value it on a clinics level, it's higher. And we as a buyer, of course, we're interested to value it on a platform level. And everybody has its own logic, backed by some story behind it. So my question is, did you actually face in your experience this kind of two valuations? And how do you face this kind of dilemma? Thank you.
That to the corporate acquirers, or are you sort of looking for?
Oh, we looked as an acquirer.
Yeah,
I can answer that.
And well, we were a little bit surprised to buy something on a clinics level, because you still have corporate expenses, yeah, but there was some kind of a logic. Well, this is the clinics who are generating the cash flow. Corporate expenses are very often linked to consolidation and consolidation.
What I would say is, in terms of if we're sort of in a process, or either we're running a process, etc., and it's depending on the buyer, I think if it's a private equity buyer, they are focusing on the EBITDA at the group level. If they have an asset where they can extract synergies, then if they're in the same market, be it France and France or Germany, clearly there's some trade synergies. You know, will you get people to pay you for clinic EBITDA? Obviously, it's in, you know, as a seller, you want to get them to pay for as much of the synergy, but I don't think that they'll be lesser advised to sort of bid off a clinic EBITDA and pay away 100% of the trade synergies. But clearly, in a competitive auction, that's the desire is to try and push as much trade synergy for that person to pay. Now, in terms of acquiring at the clinic level, small bolt-ons, that's somewhat different, right?
Yeah, my answer to that is my experience, because we went through a sale process in 2022, where now we have Eurazeo as our majority shareholder, and of course it was debated a lot, because, you know, it's always amazing. People hope that you're going to achieve that level of growth with no headquarter costs. So it's impossible. The higher your growth, you need to have people. You need to have some workforce to make sure that you deliver then the service. And of course, you have to have your workforce almost 24 months in advance before you get the first euro of the acquisition that you're going to make, and then one year to integrate it. So in the end, it's just about showing that, you know, at some point, I think it's very personal, you reach that inflection moment in which you begin to see an amortization of your HQ cost. For us, it was 2 years ago. So it took us almost 5 years to show to the market that we would be able to begin to absorb our HQ cost. And now the HQ cost at our size are approximately at 5.5% of the revenue, which is honorable. I think in that sector, what we saw at some point, it's possible in the US notably, I think we can probably reach 4%. And now we are in that journey to make sure that every year we can, you know, demonstrate that there are some synergies, and for one clinic that you buy, you don't have to put, you know, each time one people at the HQ to manage it.
At the end of the day, you need to make sure your platform has value, and then you can get it put in the valuation.
Okay, thank you.
I think we're out of time now, so I think with that we'll we'll wrap it up. And thanks very much for everyone attending.
Thank you.